This is Justin, and thanks for watching as we talk about what to do during all of this craziness. And I want to stress up front, of course, that none of this is about making anybody feel silly for feeling anxious or being bothered that the markets have gone down. That's a very unpleasant thing to experience. So perfectly normal if it makes you upset, makes you wonder, what in the world am I supposed to do now? If it makes you unhappy that you have less than you might have had a month or so ago. It's definitely an unpleasant thing for everybody. So also want to stress, don't necessarily know the future, but we do have some good information, and I guess it's the only information we have of data about the past, and those include some very scary events, unprecedented territory, and things that were just not much fun at all. So let's talk about what in the world is going on and what you can do going forward. Like I said, there's maybe a few reasons to be optimistic, and there is a free risk tolerance quiz developed by some psychologists down below that you can check out. For now, want to highlight that this was a quick one. If you didn't already notice, it was what they're calling the fastest correction in history. That's just when it was down 10%. We're obviously down more than that. And if you look at some of these 10% drops in the past, this February of 2020 drop was one of the fastest ones. So, you know, what's going on? Well, obviously, people's health and safety is at risk. That's the most important thing. So that is also, as we will see, spilling into people's personal finances. Obviously, as a result of that, places are shutting down. Disneyland shut down fairly early, and a lot of states are issuing orders to stay at home. Well, what happens when all of that goes on is that businesses can't operate. It's a little bit harder for everything to happen. And I think that's a small price to pay for everybody's health and safety, but it is a price to pay, and it's not a small one. It's not an easy pill to swallow by any means. So what happens is when people are working less, the economy's moving less, there's just less happening. That means less profits for companies that you might be investing in, less likelihood that they're going to pay dividends on a continuing basis or as much, and just that the economy might go into recession. The markets are, in fact, kind of a forward-looking beast. So I wish this was maybe zoomed in on just a couple of periods in more recent history when the markets were maybe more like they are today, maybe after World War II. But let's try to make some sense of this. So they say that the market's a forward-looking beast, and these gray areas here are recessions, right? So that's what we may be going into shortly. So what you see is the dark gray line, the upsy-downsy one is, of course, the stock market, so the S&P composite there. And if you look closely, you might just be able to see that sometimes the market starts turning down before we go into recession, starts turning down again before we go into recession there, starts turning down here again before we go into recession. And so sometimes the markets can see that coming. Now, the good news is we don't always have to wait until we're out of a recession for your investments to recover. We might have to, we might not. If I didn't already say, I don't know what the future is going to bring. We could go further down from here. We could go right back up, or we could just be range bound in an upsy-downsy kind of pattern for an uncomfortably long time. There's just no way to know, and only time will tell. And it depends on a lot of things. But as I mentioned, you know, sometimes, again, if you have to look closely, but you might see that the markets start turning up sometimes before the recession ends. And again, if the market is a forward-looking thing, what that means is that it can be hard for us to say, well, it's just going to be down until the markets, until the economy turns around, until people have, you know, more jobs and more is happening out there. The fact is that it is possible for the market to start going up before all of that in anticipation of a recovery. So, you know, let's hope that that's what happens, but that's just something that can happen in the past. So we've got all these shutdowns that affect the economy. Is the market overreacting? I just don't know. But let's get a little dose of optimism if we can. So we've got a situation where we're in uncharted territory. It's an unprecedented series of events here, to be sure. But we have been in scary events in the past. If you remember 1987, the market lost 20% plus in one day. A couple of these other ones, September 11th, obviously unprecedented. 2008, the big banks were scared to lend to each other. A lot of very freaky things. So during those, it was very unpleasant. But what are we looking at? We're looking at after 1 year, 3 years, or 5 years, how did the market behave? And this is a balanced portfolio, 60-40. So you're not 100% in the stock market. That would be a very high risk investment. When things are happening, it's very scary. But if we look out maybe a couple of years, in many of these cases, after 3 or 5 years, the markets recover. Will that happen this time? Might be faster, might be slower. I don't know, but we have some reason to be optimistic, and hopefully that gives you something to say, I can survive this. This too shall pass, because the things have tended to recover before. I guess if you want to put a nihilistic view on it, as they say, the world only ends once. And when it does, it doesn't really matter what your investments are worth, because kind of have bigger problems. So if the world's not going to end, it might look something like these. Again, very unpleasant times, a lot of suffering, very difficult stuff, but we did recover, at least in terms of the markets. That doesn't mean all of the scars are gone or anything, but the markets did tend to recover from those in the past. So, we've got stimulus coming. There's talk of something that might be the biggest stimulus since World War II. So that really could prop things up in years to come. I'm not saying that's good, bad, not a political statement or anything, but just there might be a lot of money pouring into the system, and that can help at least the markets. And it can also, get people back to work and any number of other things. And, you guys can debate what you think about that, but I'm just talking about the markets. So, and by the way, you're going to want to go on vacation after all of this, right? I mean, there's going to be a lot of pent up demand. People are holding off on major purchases. Again, exactly when that demand will come and manifest itself, who knows? But if you wanted to go on vacation and now you can't, I suspect you will want to at some point in the next couple of years, and you and everybody else, believe me, is really going to get some relief if they can spend again. So what should you do? Big question. What should you do? Well, that's a short-term and a long-term question. And so we'll talk about both of those. All right. Again, I don't know what's going to happen. Markets could go up, down, or sideways. Forgive me for this super busy chart, but we'll try to make sense of it. And we don't have to get into every single number here, but we're going to talk about what this might tell us. In the long term of what you should do, I don't think much has changed. I realize that might not be a very satisfying answer right now, but I honestly believe that long-term investing principles are still the way to go. So what we have here is across the top, you've got these years, and then going up and down, you've got different types of investments stacked from which one did best on down to which one did worst. Fixed income, cash, high yield bonds, small cap stocks, large cap stocks. The most interesting one here, by the way, I guess I'd say if you see a pattern here, good for you. It's kind of hard to tell. We call this the Skittles chart sometimes, because it's like you poured a bag of Skittles on a table and they're just kind of all mixed up, and it makes no sense. But what we might notice, and that is helpfully connected by the dotted line, is this gray area here for asset allocation. And what that means is a mixed portfolio that kind of has all of these different things in it in different measures, and it tells you that down below if you want. But the asset allocation is that pie chart where you own a little bit of everything, And depending on your risk level, that tells us, how much of each you should own. But the point being, this is never at the top and it's never at the bottom, but it always is kind of, middle of the road. And it might be a decent way to invest your money is to diversify. That's just a prudent long-term practice. Diversify that money. And you can see even year to date where everything is, suffering quite a bit. Asset allocation is kind of holding up. Again, the past cannot give us any guarantees about the future. So this could all change next week. But the point is that spreading things around can help you avoid, the worst of these extremes from way up to way down. And that may be helpful for you. It's often a good idea. So that's kind of a long-term view. And that may not be what you want to hear, but it's just the boring kind of way to do it. Shorter term, should you sell? Well, I don't know. Is it too late to sell? I don't know. Honestly, don't know. It might be, it might not be. Selling is always tricky because occasionally people do get it right. Maybe even more than occasionally. Back in February, if you were worried about this, you might decide to sell, and some people certainly did. The tricky part about that is getting back in. All right, so when is it all clear? When you get the green light? There is no green light, unfortunately. So you see a lot of people who got out during times of crisis, never really knew when to get back in. They see that ship has sailed. If the markets start recovering, they think it may be too late to get in. They're waiting for another crash. Who knows? The old saying goes that more money has been lost waiting for crashes than in actual crashes themselves. It's just really hard. So, I hesitate to show this one because it's, kind of like wagging a finger at people to criticize them. And I get that it is very scary and unpleasant to lose money. But, a little bit of data may help us have fortitude if we're going to ride it out. It may help reinforce what we're doing if we're going to ride it out. So, this is the classic, what happens if you miss the best couple of days? Well, if you stayed in, the S&P 500, 1990 to 2019, you made about 9.96% per year. Again, past performance is no guarantee of the future. If you miss the one best day, this is the biggest up day of that period, you earn a little bit less. Let's say you missed the 5 best, 15 best, 25, etc. So what it can do is bring down, even just missing a couple of good days during a 20-year period can substantially hurt your performance. And so, these big up days tend to be kind of clumped with the big down days, at least in recent history. It's kind of all clumped together, these big upsy, downsy things. So getting out might actually mean missing, some of those recovery days. Who knows, right? Obviously, you could build a chart that said, well, if you miss the worst day or the 5 or the 15 worst days, you'd have fantastic performance. That's not possible, but there's an argument to be made on both sides, but this is to show you that it is really hard, and sometimes the best thing to do might just be to kind of stick there, ride it out. You can reduce your risk by not being 100% in stock. You don't have to be all in the S&P 500 index. There are different types of bonds that can dampen the volatility. International stocks, small cap stocks, small, of course, is doing very badly during all of this. But over different situations, over long periods, having money spread out into different places could potentially help you. So again, don't want to spend a lot of time on this because it feels like that finger wagging thing where you're telling people, you messed up or something. But this is, showing over a couple different viruses when we had a sell-off. What if people went to bonds, and that's the light purple line, instead of writing it out? And they happen to do it right at the bottom. I mean, these people have the worst luck ever, apparently. But the point they're trying to make is that the markets did eventually recover. By the way, it's a very difficult time to ride this out, you know, because you see in this one, we came down and then it came back up and you might have thought all clear, that's great. But then it came back down again. And, you know, there's just a lot of bounciness and upsy downsiness, just really hard to make sense of what exactly is happening during situations like this. That's why it may be best to, you know, pretty much just avoid that stuff. So do a good job of making that asset allocation, doing that mix of investments, picking the right mix that is designed for your risk level. So it's going to account for these things, whatever these things end up being. We can't predict the future, but we know there are going to be bad things. There are going to be panics. I don't even want to start talking about all the unpleasant things that can happen, but they would happen. And so we design a portfolio for whatever that might be, and then, you know, you pick your risk level accordingly. So that's sort of a short-term thing. You might even say, well, look, I inherited some money. I have extra cash sitting around from just, I was saving it. I sold a business, whatever. Should I buy? Well, you know, the answer to that is also, I don't know. You know, if you are okay with it going down more after you do that, then that could make sense. Just most people aren't as okay with that as they think when it actually happens. So it might be a good idea to do a really good job of picking that investment mix at the right risk level, as well as, you know, you could use a systematic investment purchase. So over, let's say, every month or every couple of months, you're putting in a certain amount, just a portion of what you have to invest. And you do that over, maybe it's 6 months, maybe it's a year, maybe it's 3 years. You know, might be longer, might be shorter than any of those periods, but you set something up and you do hands off. So there's no decision making to be made. There's no emotional involvement to say, well, now's not the right time, or now's a great time to do more, because, you know, as we saw, sometimes it goes up and heads back down. You just take all of that out and you let it go, and eventually you get invested appropriately for what your goals and needs are. That's a decent way to handle things over the short term. I don't have a good answer if you're just saying, look, I'm freaked out and I just need to sell. I mean, if you absolutely cannot sleep, it's affecting your health and all that, you know, certainly good to talk to somebody before actually doing something. But if you have to do something, you have to do something. But remember, it doesn't have to be black or white. You know, you don't have to say, well, I'm either all invested or I'm totally cashing out. You know, you can just reduce your risk. You can sell some of what you have. You can shift some of it into safer investments. And the important word there being some, you know, so you can pick the level that is right for you, whether it's 25% or 75% or 50% or whatever it might be. It doesn't need to be black or white. Another thing to keep in mind is that long-term is an investor's best friend, or at least that's the way it's been in the past. And again, what can we learn from, you know, all we have is the past, doesn't necessarily predict the future. But what are we looking at here? Well, before we even look at the numbers, let's just kind of look at the shapes. We can see that these lines kind of narrow, right? Kind of narrow as we go from left to right. And you might even argue that they kind of bump up around, bump up above that 0% line, possibly. You know, maybe that's my perception, my bias, but that might be what's happening. So we've got the green is all stocks. That's 100% stock. That's that risky investment mix. So, and it's a 1 year period here. Over any 1 year period during this historical period, 1950 to 2019, could have been up, you know, 40-something%, down almost 40%, depending on what numbers you look at. And you might as well go to the casino with those numbers, because that's just all over the board. Next is the bonds in blue, or a 50-50 portfolio, which is, you know, half stocks, half bonds. So of course, adding in bonds can reduce your risk. Now, longer periods can also reduce your risk. So a 5-year rolling period, a 10-year rolling period, what does that mean? Well, on the 5-year rolling period, let's say that's 1980 to 1985. And then the next rolling period is 1981 to 1986, and then 1982 to 1987, and so on. So it's each of those slices in history. Well, over 5-year periods, not quite as wild of a range as in the 1-year periods. And then in even longer periods, not quite as wild of a range. So as difficult as it is now, and it is difficult, can we look at a longer term perspective and say, you know what, this might kind of get smoothed out, might iron out those wrinkles over a longer period of time if I can just hang in. So again, knowing that if you want to invest now or if you're riding it out, we might not have this sharp V-shaped thing, might not be a V-shaped recovery, but over long periods of time, I believe at least, I can't predict the future, but I believe at least that things should be higher at some point in the future. So the question becomes, when do you need the money? Are you retiring next year? And if so, maybe you don't need to cash it all out, but you can, take things out in pieces, and maybe you're not retiring next year. Maybe you have a lot of time before your goal, and that would be good news. So what I hope you do is just, think long-term, diversify, and pick the right level of risk for you. Now, whether or not right now is the right time to change that is a discussion, that's probably merits more time. But ultimately, at some point, we want to be at the right risk level for you. So there is a free risk tolerance questionnaire on my website. It might be right below, depending on where you are watching this. And you can go through there and answer some questions. It's put together by some psychologists, so it's kind of neat. I've seen one of these people at a conference, the Financial Therapy Association. They discuss, it's not just the typical what would happen if you lost 20%, because when people fill those out, they say, yeah, that wouldn't bother me. But when you really lose 20%, it does bother a lot of people. So that may help you kind of take your temperature, and you can use that in combination, not by itself, but in combination with a lot of other resources to help you determine how much risk you might want to take. So I hope that's really helpful. Please let me know if you'd like to chat. I'm happy to go over these things with you and talk about even more. So I hope you're doing very well, that your loved ones are safe and well, and that for everybody's sake, that this whole virus thing is behind us sooner than later. So take care.